You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm Kerry Lutz. Well, Fed has spoken, the markets are reacting, but we're also seeing gyrations from a huge options expiration taking place right this moment. It's Friday, December 16th. That'll be over with just after noon. And Drew Pelton's with us now to discuss the Fed's latest posturing, what you see down the road, Drew, and how to position yourself to try to soften the blow of further Fed moves.
Sure. There's a whole lot in that question, but, I'm not sure that the 50 basis points or 0.5% increase in the Fed rate on December 14th was as much the problem as Jerome Powell's words about tightening things. I don't think, that's when you ask the American public, effectively inclusive of the markets, our country to tighten, that's not a good qualitative, that's not qualitative to me, but it's not a good, those are not good words to encourage the economy. So, the whole number, the numbers are, what they are. Inflation has come down a little bit. I just did my radio show recording for New Year's Eve because we do it in advance, and I was just addressing the whole thing about inflation. And wow, we're down to 7%. That's exciting, from 9%. Really? Well, it's still 7%. We have to remember that.
That's what they admit to. And let's face it, we all know that they have changed the method in which they calculate inflation over the past 40 years. If it was done the way it was done, when Volcker was chairman of the Fed, we'd be in double digits for sure. So, but in the meantime, we still have this inverted yield curve that is flashing recession. It's been that way for 118 days. That's pretty huge. And the Fed keeps trying to get out ahead of the 2-year, and they just can't seem to catch up, can they?
Yeah, agreed. So let's say maybe for the audience, what is an inverted yield curve? It's when the short-term interest rates, like the short-term U.S. Treasury rates, are higher than the long-term rates. So, you look at the 2-year note that's 4% plus. I don't know what it is exactly this day. The 10-year Treasury is below that, to say the least. So that's our inverted yield curve. That's normally an indication that we are going to have a recession. Some would say we're acting like we're in a recession. I read something that Bloomberg said there was a 100% chance of a recession in 2023.
Yeah, and that's being optimistic, huh?
Yes. You did ask, by the way, what do people do? Well, what's interesting is with interest rates, even on the short term, being in this 4% level. I mean, I find some clients asking me, Drew, I'll take 4%, give me 4% for a year or two, then we'll see how things settle down. The other thing that I think needs to be just simply understood is when people say, I can at least get 4%, maybe 5% in the short term, why should I take the risk in the stock market? Depending on what we're looking at in terms of the S&P or NASDAQ, et cetera. I mean, a lot of people are down at least 15%, some easily 25% from the start of the year in their stock market holdings.
Yeah, this is true. So what are you supposed to do here, Drew? What is the best thing you can do here with your money?
Well, I believe that the first thing always before one says, what do you do with your money, is to ask the individual three basic questions. One is, are you conservative, moderate, or aggressive? And where are you on that spectrum? And do you really understand what conservative means, relative to your choices? Secondly, what percentage of monies do you want in the stock market? And third, what do you think is going to happen? And, that's a place to begin to say, okay, where do I go? Because I don't think it's a broad brush panacea, a broad brush answer for everybody. And if everybody starts with those qualitative questions, one can get to more over or more so what they might do. But I do think that, treasury notes might be a way to go right now, or there are even certain bonds and bond ETFs. It's a tough market, but, there are some rates of or interest that can be generated in the 4 to 5% range, and you'd be minimizing your risk in the markets if one is heavily invested in the markets. So maybe it's a wait and see. That's one strategy. Always a good strategy is to make sure your balance is reflecting your goals and objectives. As I was saying, some of these questions can help one think about.
Well, at some point, the market will turn around. If we go back to the 30s, the market had several huge rallies after the crash of 29. I think in 34 and 37, if I remember correctly, had huge advances. Everybody thought it was the end of the world. They stayed out of the market. Don't you run the risk of that happening again here? Because back then they were saying the same thing, that the market is divorced from the real economy, that the economy is in the dumps and the stock market's going crazy. It's going up and away. So, there's nothing new here, is there?
Well, I agree. I think that what I'm hearing you say, and I would agree with, is a long-term perspective, a secular market perspective makes sense. And one of the places or ways people get into trouble is they overreact, and they may pull out of the stock market and then lose the opportunity. There's certainly something about buy and hold, but I do think there's an issue with retirees not understanding the risk as well as taking money out of a down market. So that's something else.
In other words, they zig when they should zag, and they zag when they should zig, because we know individual investors as a lot are much more emotionally driven than professionals and big money investors. Doesn't mean that the professionals and the big money investors can't lose money either. It just means that they are less apt to make emotional decisions, right?
Absolutely. Emotions are definitely a problem for, if I may say, the average investor.
Mm-hmm. Yeah, I remember.
However, go ahead.
I remember a sign from the 60s. It was in my mother's office. It said, "Don't just stand there, panic," right? So, and it seems like individual investors are quite good at that, right?
They are very good at that.
All right. So as a strategy, though, emotions are not a strategy, right? An investing strategy. How do you come up with a strategy here that's actually going to help you get through what's going on?
Don't just survive, thrive. The Financial Survival Network.
Torque Resources is an exploration company establishing a portfolio of premier copper-gold early-stage projects in Chile. Torque's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita copper-gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration communication system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torque trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqueresources.com. That's torqueresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Well, my being in the retirement planning business, I always have this tendency to think long term. I do think that no matter whether somebody's planning for retirement or they're listening to this show and they're not near retirement, that the long-term thinking always does make sense. I think a balance, diversification makes sense. I also believe that individual securities, investing in individual securities that pay high dividends, particularly if you're in the stock market, is an approach that generally provides greater stability and greater predictability of returns with the higher dividends. Where people get into trouble with mutual funds is, and just looking at the average, 80 to 90% of mutual funds underperform the S&P 500 index over a 20-year, 10 to 20-year period of time. And the S&P has a dividend average of about 1.5% in dividends. So mutual funds can be a problem in and of itself. So I think it's the individual it's the approach of individual securities that could help somebody, just no matter what is the situation, is long-term or right now going into 2023.
Right. And a lot of the reason why those funds underperform Wall Street, the indexes, is because of fees and things like that, not necessarily investment strategy. If you're nearing retirement or you're older, better off going with an ETF than a actual mutual fund?
I think it's always hard to give the broad brush general yes, but yes, I think for the most part, the ETFs, exchange traded funds, are certainly got on average much lower fees. And back to what I just said in terms of mutual funds not doing what the averages are. Typically in exchange, you get that predictability, that average, that index of that exchange fund, and probably get a better return with those lower fees.
All right. Well, hey, there's nothing wrong with a better return, right?
That's what we all need and want all the time, every day.
All right. Well, hey, for you, at your point in life, how are you riding out the market for your personal portfolio? We should ask that.
I'll say I practice what I preach.
You eat your own cooking?
Yeah, I do. Right. I have a very balanced portfolio. I will say I do not use mutual funds. I use some ETFs. Mm-hmm. I utilize individual bonds, individual stocks, BDCs, business development corporations, and REITs, real estate investment trusts. And my wife and I actually have some fixed index annuities built in there for some safety of principal, and ones that don't have any fees, by the way, not variable annuities.
You got to be careful of those annuities, though, don't you?
Oh, you definitely, not all annuities are the same. It just seems like the typical stockbroker will say broad brush categorically, can't do well in annuities. Well, to me, the word annuity is like food or medicine. That's a general term.
Right. Yeah.
Variable annuities, very high fees. Not all fixed index annuities are the same. You have to understand, what's a SPIA and what's a fixed annuity, a fixed index annuity. You have to know that world for sure to get it right for your goals and objectives.
All right. Well, hey, I think we've given people a lot to chew over here. Hey, looking ahead for the coming year, what do you think we're going to see, dusting off your crystal ball?
At best, I think we are flat or marginally up at best. I believe that depending, it's such a hard market, hard world to call with all the moving parts. But we could see some further declines, based upon some of the things we talked about earlier, and interest rates going up, cost of, inflation still not under control. All of that does not bode well for the markets. So this could be a further rocky road this year. It's what I'm anticipating, a fair amount of volatility still yet to come.
And your feeling about the war in Ukraine, if it drags on, volatility going to still be crazy, though, like the way it's been?
I think my first reaction to that is I'm not so sure. I see the war as just part of the many problems and the issues. Certainly, the issue of the war and what's the price of oil and that whole trying to keep this condensed, because that's a big question. But I think if the war continues, it's not going to be helpful.
Yeah. Well, it certainly hasn't been helpful to date. But if you're an energy investor, it's been helpful, hasn't it?
Yeah, it's amazing.
Hey, what are you thinking for energy coming year?
I think we're going to still see the oil prices, or I'll say the value of the oil stocks, whether that's Exxon or Chevron or Shell, to name three big ones. I think they're going to continue to keep their prices, and I think we got more of the same that's going to go forward here in 2023, and that's why I think that.
All right. Well, that old saying, Eisenhower said it, I think things are more like they are now than they've ever been before, right?
Right.
So quite a mess things are in. So you can't be conservative, but you can't be too risky. You've got to kind of try to negotiate or navigate a middle path here. And that's not easy. And I don't think most of you out there are kind of that mindset. I know it's hard for myself, and I wouldn't call myself a professional investor, but perhaps a educated investor. And I guess that's the best you could do, is be an educated investor. Keep your eyes open. Don't get married to any particular investment over time. They're vehicles, and just like you buy vehicles, you drive them for a while, and then it's time for a new one. And I think that's the way you have to look at your investments. Drew, best place to find you, drewpelton.com.
That's a good and great place. Yes, that's our website.
All right. Well, make sure you click it. It's in the link to this interview, to the show notes on financialsurvivalnetwork.com. While you're there, sign up for your free newsletter, shoot us an email. Drew will be happy to answer any questions you might have, as will I, KL@kerrylutz.com. Drew, healthy, happy New Year, Merry Christmas, all that.
Yes, same. Merry Christmas, Happy New Year. Thanks, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.